In January 2020, GameStop traded about $4 a share. 12 months later, it touched $348. That is not a typo. A brick and mortar video game retailer, the kind with clearance bins and used controller smell, went from the bargain bin of the stock market to the most talked about ticker on the planet. And the story of how it happened is really a story about options. Hey, so I want to break this down properly because most people tell this story wrong. They make it about Reddit versus Wall Street, David versus Goliath. And yeah, there is some of that, but the actual mechanism, the thing that made the price move, that is the interesting part. Let's get into it. First, a quick primer. A stock option is a contract that gives you the right, not the obligation, to buy or sell a stock at a specific price by a specific date. A call option is a bet that the price goes up. A put is a bet it goes down. Here is the key thing. One option controls 100 shares. So if you buy one call option on a $20 stock and it goes to 40, you are not making 20 bucks. You are making 2,000 on a contract that might have cost you a few $100s. That leverage is what makes options powerful, and it is what made GameStop possible. Look at this chart. See that flat line running through most of 2020? That is GameStop trading between $4 and $6. Nobody cared. The company was widely considered a dying retailer, but a Massachusetts financial educator named Keith Gill, known online as Deep Fucking Value, disagreed. He started buying call options on GME in mid-2019, when the stock was around $5. His initial position was about $53,000 in options. At the time, the post got almost no engagement. People thought he was throwing money away. Now here is where it gets interesting. By late 2020, GameStop had a short interest of over 140%. Take a look at this number. More than 140% of the available shares had been sold short. That means hedge funds had borrowed and sold more shares than actually existed in the public float. How is that even possible? Through a chain of borrowing and relending. But the practical result is simple. If the price goes up instead of down, those short sellers have to buy shares to cover their positions. And with 140% of the float sold short, there simply are not enough shares to go around. Okay, so here is the part most people skip over, and it is actually the most important bit. When you buy a call option, you are buying it from a market maker. And that market maker does not want to take a directional bet. They want to stay neutral. So they hedge by buying shares of the underlying stock. The further the price moves towards your strike, the more shares they have to buy. That forced buying pushes the price up even more. It is a feedback loop, that is a gamma squeeze. So look at this chart. The week of the 11th of January to the 29th, 2021, you can see the price starting to move on the 13th, picking up speed through the week. Here is what is happening underneath. Retail traders on Wall Street bets are buying out of the money call options in large volumes. Market makers are delta hedging those positions by buying GME shares. That buying pressure pushes the stock price up, which brings more call options into the money, which forces market makers to buy even more shares. Meanwhile, short sellers are starting to get margin calls. They need to buy shares too. You have got two sources of forced buying happening simultaneously. The gamma squeeze from options hedging and the short squeeze from covering. The result is what you see on the chart. Look at the volume bars on this chart. In a normal week, GameStop might trade 10 to 15 million shares a day. On the 22nd of January, it traded 197 million. The stock closed at $65 that Friday, up from about 40 at the open. Then came Monday, the 25th. GME opened above 96 and hit a high of 159. Tuesday, it touched 247. And on Wednesday, the 27th of January, the peak, GameStop hit $347.51 intraday on volume of 93 million shares. Keith Gill's $53,000 options position was now worth roughly $48 million. On the morning of the 28th of January, Robinhood and several other brokerages restricted buying of GameStop shares. Users could sell, but they could not buy. The stock dropped from a pre-market high of over $500 to $112 by the close. Melvin Capital, which had held a major short position, lost approximately 53% of its fund value in January alone, roughly $4.5 billion. They received an emergency $2.75 billion capital injection from Citadel and $0.72 to stay solvent. Here is what I find interesting about all of this. The mechanics were not new. Gamma squeezes had happened before. Short squeezes had happened before. What was new was who was doing it. Retail traders coordinating in public on a forum, using the same instruments that institutional investors use every day. And that changed the conversation permanently. The GameStop episode accelerated trends that were already underway. Retail options trading, which had been growing since brokerages eliminated commissions in 2019, went vertical. The CBA introduced same-day expiry options, 0 DTE, on the S&P 500 in 2022, and they now account for over 40% of all SPX options volume. Congressional hearings followed. The SEC published a 45-page report, and GameStop itself used the elevated stock price to raise over $1 billion in equity, fundamentally improving its balance sheet. The GameStop squeeze was not magic, and it was not a glitch. It was leverage, mechanics, and timing. A crowded short, a flood of call buying, and a feedback loop that the market's own structure made inevitable. Understanding those mechanics, that is what this channel is about. Thanks for watching.